It's an annual rate to ensure 11% return.
Okay.
It's 12%, and the implicit rate of the leaser is unknown.
Alright, so the 11% is the one we're going to use because that's the return that they're wanting to get on this lease.
Okay.
And so that's known as our implicit rate. And then we don't know our payment, so that's what we're going to be looking for. And then our present value is going to be our fair value of the asset. Okay, and yeah, and that's going to be negative because the lessor is giving this asset out of their company, so that's like a negative.
So it's leaving
to them, yeah. And then the future value is going to be either your residual value, either guaranteed or unguaranteed for the lessor, or a bargain purchase option. And if there is a bargain purchase option, you're going to want to use that one.
The bargain one?
Mm-hmm.
If there's a bargain value, you want to use the bargain value?
Yeah, but I don't think that there's one in this problem.
Okay.
Okay. And so the residual value is basically like what the lessor is going to get back at the end of the lease.
And then due on January 1st being, so is it so there's going to be a type 1?
Mm-hmm, that's the beginning of the period. And then I think it gave us an unguaranteed residual value.
Yeah, 10,000.
10,000. Okay, and that's going to be positive because that's what they're expecting to get back. All right, so then we're just going to solve for the payment.
Okay. Got 30,804.
All right. Okay. So this number is going to be really important. That payment. Let's see. Okay. So now what the lessor has to do is figure out what their lease payments receivable is going to be, and that's what they're going to record on their books. And the way that we do that is, let me back up for just a second. This is known as our minimum lease payment or minimum rental payments. Okay, and so what we're going to do is have a computation down here to find our lease payments receivable. So it'll be the total number of those minimum lease payments plus any residual value or bargain purchase option. So
this is going to be, what number is this again? What was this number represent?
This one? This is the minimum lease payment.
Okay.
And then
adding, so you're going to add that, you're going to times that by 6, and you're going to add the future value.
Yeah.
What's that number mean?
This is going to give us our lease payments receivable. And most of the time we're just going to abbreviate that LPR. So we're going to have our 30,804 times 6 plus our 10,000 of future value.
So, okay. $125.
Mm-hmm. So 194, 825.
Mm-hmm.
Okay. So this is our lease payment receivable. And that's the total amount that we're going to be getting from them over the life of this lease. And let's see. So what we do next after finding this number is we're going to find the unearned interest revenue. And
is that the difference between the present value and the
mm-hmm.
and that?
Yeah.
So we're finding the, what's it called again?
Unearned interest revenue, and just UIR. So sometimes he's going to be asking for this number, just what's the unearned interest revenue, and it's basically testing you to make sure that you can get to the minimum or the lease payments receivable and get like the right number that way.
Mm-hmm. Okay.
Mm-hmm. And then sometimes you're going to need the depreciation of the asset, because with a capital lease, they're going to be putting their asset on their books. If it's just operating, it's just rent expense and cash. So, yeah, whenever there's a capital lease, there's going to be depreciation of that asset.
Okay.
Okay.